Good afternoon. My name is Jesse Medcalf and I'll be presenting for Westlake Boys High School. To my left we have our team, Sam Walsh and Yishin Zhao. The Reserve Bank of New Zealand has today made the decision to leave the official cash rate unchanged at 2.5%. This decision is made in recognition of the Policy Targets Agreement to keep inflation between 1 to 3% in the medium term. Our decision has been influenced by various economic factors modelled on the aggregate demand equation. Sam will be reviewing consumer spending, including the housing market, mortgage rates, the Canterbury rebuild, and the unemployment rate. He will then review changes to government spending. Yishin will take you through investment and changes to imports and exports, including overseas market, oil prices, and the drought. I will then return and conclude with a discussion on the output gap, inflationary expectations, our inflation outlook, and future OCR decisions. I'll now hand you over to Sam.
The housing market has been very strong in recent times, as can be seen here with rapidly increasing prices, and here with increasing sales. Supply shortages, strong demand, and low mortgage rates have all contributed to this asset price inflation, which has been especially prevalent in Auckland and Christchurch, but is now spreading to the rest of the country, increasing inflationary pressure through the wealth effect. To ensure that financial stability in New Zealand is not compromised in the event of a burst in the housing bubble, the Reserve Bank is implementing macroprudential policy. Tools, which include restricting the availability of low deposit mortgages, are expected to take a small amount of heat out of the property market, as well as increasing the resilience of the banking sector in the event of a harmful bust. In the short to mid-term, however, the strong housing market will be a driving force behind the increase in non-tradables inflation. As we can see here, retail interest and mortgage rates are at 50-year lows. These low rates have resulted in an increase in private sector credit faster than the rate of income growth. Whilst, in the short run, this will continue to increase inflationary pressure through high consumer borrowing and spending, it is also a major contributing factor to the high household debt level. Interest and mortgage rates are expected to increase in 2014. As credit becomes more expensive to obtain, pressures on inflation will ease. Despite the slight rebound in the unemployment rate in the last quarter, unemployment has been falling. We expect it to continue to fall to around 5% by 2014-15 as the domestic economy continues to strengthen, business confidence improves, and net migration remains high, meaning upward pressure on AD. This, coupled with increased pressure on wages, will increase inflationary pressure. Factors such as high house prices, falling unemployment, and low interest rates have seen consumer confidence rise to its highest level in over 3 years, as shown here with a high of 116.6 in the last Westpac survey. This is a sign that consumers will increase spending in the near future, increasing AD and inflationary pressure. While the increase in construction work has largely been contained to the Canterbury region, positive net migration flows and an increase in both residential and non-residential building consent issuance is likely to result in a nationwide boom in construction, as can be seen here. As a result, the strong increase in resource pressures and construction costs, which have been observed in Christchurch, will start to spread to the rest of the country, increasing inflationary pressure. The recent government budget, although allowing for an increase of $100 million in spending, reaffirmed the goal of a budget surplus by 2014-15. As a result, fiscal policy will become more contractionary, and the government will limit its spending by such means as tightening access to social welfare. This will ease inflationary pressure, but will be partially offset by increase in excise taxes on tobacco and petrol, which will increase cost-push inflation. Overall, fiscal consolidation is expected to reduce GDP by about 0.6% per annum.
As we can see, business confidence reached a new high in July of 50.1. This surge in business confidence is spearheaded by the strengthening construction industry as well as improved firm profitability. As the domestic economy continues to strengthen, business confidence should sustain its high levels. As a result, investment by businesses will increase, putting upward pressure on aggregate demand and inflation. Overseas, Chinese growth has been slowing since 2011, as shown on this graph, and looks set to fall below 7%. However, the reduction in growth has come about as a result of a structural change from investment-led growth towards growth driven by consumption by the growing middle class. As a result, the market for milk powder, butter, and cheese should remain strong, and New Zealand will be largely insulated from the effects of slowing Chinese growth long term. The recent Fonterra scandal, however, will be an offsetting factor which reduces our net exports short term. Conditions in Europe, although aided by monetary easing and improving market sentiment, remain turbulent with continuing financial instability. As you can see on this graph, the Eurozone is only just out of recession. Despite rising household consumption levels and a strengthening housing market, the United States remains troubled by its persistently high unemployment rate, which was 7.6% in the last quarter. Growth is increasing slowly, but continues to be tempered by the sequester. In aggregate, growth overseas still remains slow, and thus we can expect a modest reduction in export receipts in the near future, easing inflationary pressures. A high terms of trade, comparatively high interest rates, and quantitative easing overseas has seen the New Zealand dollar remain structurally overvalued, constraining aggregate demand. However, as can be seen by the blue line on this graph, the New Zealand dollar has depreciated recently against the US and is expected to end the year below 80 cents as US growth picks up and the Fed cuts back on quantitative easing. This expected depreciation would mean an increase in prices of those imported goods which feed directly into the CPI, increased raw material costs, and increased demand for exports. All of these factors will in turn increase inflationary pressure over the medium term. This will be partially offset, however, by a struggling Australian economy with decreasing interest rates, which all continue to drive the New Zealand dollar high against the Australian dollar, reducing export receipts from our second biggest export market. According to West Texas Intermediate, there will be a gradual decline in oil prices from 2014. In New Zealand, this means lower relative import prices, increasing aggregate supply, and easing pressures on inflation. The drought reduced meat and milk production sharply in the 2012-2013 dairying season. This has seen a reduction in farmer incomes and export volumes, which, along with the negative effects on the electricity generation sector, is predicted to have reduced growth over the first half of 2013 by 0.5%. This is despite the partially offsetting contribution of the drought to strong increases in dairying prices.
As evident on this graph, New Zealand's output gap is becoming positive, illustrating that actual GDP is growing faster than potential GDP. As a result, resource pressures will accumulate, and those factors which increase aggregate demand will have a larger impact on inflation. Inflationary expectations have been falling as of late, but are expected to stabilise at around 2%. With workers expecting prices to increase gradually over the next 1 to 2 years, they will start to bid for higher wages, increasing cost-push inflationary pressures now. In conclusion, in recognition of the Policy Targets Agreement, we, the Reserve Bank of New Zealand, have decided to keep the OCR at 2.5%. Inflation in the last quarter was 0.2%, still below the RBNZ's target band of 1 to 3%. In the short to mid-term, inflationary pressures created by the Canterbury rebuild, the booming housing market, decreasing unemployment, increasing business and consumer confidence, growth in commodity prices, and a depreciating dollar will outweigh the dampening effects of the drought, fiscal consolidation, and weak international economic conditions. Therefore, we expect CPI inflation to increase into the target band in the short to mid-term if the OCR is held constant. However, to ensure that non-tradable inflation does not get out of hand and that the housing market is not vulnerable to a harmful bust, an increase in the OCR will be necessary in the near future. In order to ascertain when, the RBNZ has decided to closely monitor a few specific factors, namely the effect of macroprudential tools on the property market, the extent to which increases in construction costs spill over into the general price level, the rate of depreciation of the New Zealand dollar, and the rate of domestic economic growth. Thank you. We now open the floor to any questions.
Okay. Thanks very much, guys. It's very good. So is it all good if I start questioning?
Please.
Okay. So I really like your last slide where you discuss where the OCR is going to go in the future and what risks may change that view. And so I'm going to ask you a question on it. So the Reserve Bank also does this when we publish our projections. Why do we do it?
Well, they've got to have a look at what factors could influence when they're going to up the OCR, because businesses especially need to have confidence in when things are going to happen. So if they can be monitoring the factors that the RBNZ is monitoring at the same time as the RBNZ, then they can make better predictions and feel more confident about when the OCR is going to change, rather than being taken by surprise, having less confidence, and then being less likely to invest.
And it also influences like how many workers they hire and the resources they consume and how much investment they want to do. And so by having this inflation projection, it allows them to plan ahead with confidence.
So it's all about the prevailing market view and expectations.
Anything else? All right. So in summary, we think that they publish these projections about when they're going to change the official cash rate to ensure that businesses can plan effectively, so that they can be monitoring these factors at the same time as the RBNZ. Therefore, they'll be more knowledgeable about when the OCR is going to change, so they can make better decisions and feel more confident about what they're doing in their business practices.
Okay, thanks very much.
No worries.
Good. Can you explain why the Reserve Bank has a target for inflation of between 1% and 3%?
So basically we should look at both why we wouldn't want it to fall below 1 and why we wouldn't want it to go above 3.
Yeah.
So in terms of too high inflation, major effect of that is on business planning and investment planning. So
yeah, it's hard to plan for how much activity they're going to have, and hard to plan for how much they're going to invest. And then there's also the fact that people feel like their wages mean less and less. Often they'll push for wage increases anyway, but as prices start to rise, consumers become less confident about the economy. So that's
and also too high inflation will erode the value of savings and incomes, which means in the long run growth and long run employment, it makes it much less sustainable. And
so especially people on fixed incomes that struggle to push their incomes higher. So salary wages tend to be more affected as well. And so as a result of why we wouldn't want it to fall below 1%.
That would be because of deflation. It stops growth in the economy because it discourages investment, it discourages spending, and that would lead to an even worse deflationary cycle. And the Great Depression is a good example of that.
And Japan in the 1990s, the fact that people didn't want to invest anything because they thought that prices were going to decrease, so there's no incentive to invest now to make a gain later. Did you have anything else on that, Sam?
Inflationary expectations. If they think things are going to be cheaper now, they're not going to buy now, and it's the deflationary spiral. So the businesses will face lower prices, which will lower their profits, lowering the number of people they employ, which will in turn lower consumer spending, and continue on that cycle.
Try to sum that up for me.
I'll sum that up.
Sure, you go for it, Sam.
So in terms of why we want it to stay between 1% and 3%, because that's sustainable, and it means that businesses are receiving more profits, and it's just a sign of overall growth. We wouldn't want it to go above 3% because we would risk an inflationary wage price spiral where people think that prices are going to keep increasing, so they bid for higher wages, increasing firms' cost of production costs, increasing inflation now. It would affect business planning and investment planning, as well as long-run growth and employment sustainability because of eroding values of savings and people on fixed incomes being negatively affecting aggregate demand in the long run. And in terms of why we wouldn't want it to fall below 1%, we risk deflation. And if we look at inflationary expectations, if people think that prices are going to decrease in the future, they'll wait for that and not spend now, which will in turn cause more deflation. Businesses will be receiving less money for their goods. They won't have as much of an incentive to produce. They'll hire fewer workers. Those workers will have less income, and the spiral will continue with less consumer spending and aggregate demand, damaging the economy.
Thank you. Good. Just a quick follow-up question. So currently inflation is below our target band. Do you think this is a problem?
Not
Well, not a problem in the midterm. So obviously we would like grow. It's a sign that growth is on its way back up. It hasn't increased to the level we'd like it to yet, but it's
not deflationary.
No, it's not deflationary, and it's only a small problem in the sense that we'd like it to increase in the future, which it naturally is as growth picks up. So there's no need to take any action against it by say lowering the OCR, because that would growth is looking like it's going to be sustainable as it is, which will push inflation into the target band.
And the Reserve Bank's mandate allows for those short-term fluctuations outside of the target band, as long as in the midterm they will be inside, which looking at the economy at the moment, they definitely will be. So.
Excellent. Are you happy to sum that up?
So basically, the Reserve Bank looks at the medium term, not the short term, and so we think it's quite suitable for the current rate of inflation to be below the 1 to 3% region, because the rate of inflation will naturally increase due to the reasons we laid out, and so it's not really a worry, and it's definitely not deflationary, so it's not going to stomp out growth or anything. So we think it's perfectly acceptable for now.
Good. Okay, just a quick follow-up question. Suppose we could go back in history 12 months, knowing that currently we've got inflation below the target band. Would you have changed the decision that was made 12 months ago?
So 12 months ago, we'd been keeping the OCR the same for a long.
So if
time.
we'd known that it would be low, the question is, would we have reduced it then?
Well, if we'd reduced it, we would have stimulated more growth. But then there's also, I mean, in the last 12 months, what we've seen is that huge increase in house prices. So that would have sort of fostered that even more.
We really don't want to let inflation run away.
Yes, it's far better to keep it under control and see that in the medium term it's going to be pushing up into that 1 to 3% band, rather than lowering it, because obviously things take a long time to kick in. So lowering it too early it could lead to inflation running away, which is nothing we want.
Definitely looking at the housing market as well, with the financial instability that's been potentially going to cause, and that's definitely in the Reserve Bank's mandate. So lowering of the OCR 12 months ago would have just made that much worse and made us much more vulnerable to an external shock in the New Zealand economy, which would have undermined financial stability.
It also would have pushed up the New Zealand dollar, decreasing the OCR.
Decreasing the
OCR 12 months ago pushed up the.
If you decrease the OCR, that would have put downward pressure on New Zealand dollar. Okay. That links into the inflation point, runaway inflation.
Yes.
Inflation control.
Yes.
Okay. So in terms of why we are happy with what we did 12 months ago, keeping it at 2.5%, we really don't want to let inflation run away. So we're happy with keeping it just below the target band in the short term, because the problem with reducing it 12 months ago is that we've already got all these upward pressures now. We can't let it the inflation run away. And looking at the housing market as well, prices have been increasing rapidly. That would have only stoked that housing market, leading the New Zealand economy to be much more vulnerable to an external shock, undermining financial stability.
Good. Thank you.
I was going to ask that last question, so I've changed my mind a bit. So you talked about in that answer how lowering the OCR 12 months ago would have exacerbated the housing boom, leaving it vulnerable to a crash. Could you run through some of the effects, if a crash did happen in the housing market, some of the effects that might have?
Well, I'll start off with negative equity, which basically means that homeowners with mortgages, the value of their mortgages actually exceed the value of their property, and that has an effect on their spending and AD. Obviously, that will
how wealthy
reduce.
they feel.
Yeah, as well as mortgage defaults, which really affects bank balance sheets as well. So if people default on their mortgages, it's much more risky for banks and bad for them.
So it could lead on, it could have multiple follow-up effects on banks and the banking sector, and that would actually go on to other sectors.
Yeah,
throughout
so
the
it's
economy.
basically financial stability as well as the overall level of aggregate demand and economic growth in the economy.
And if the banks start struggling, then they're going to struggle to give up credit and that sort of thing as well, which will again decrease that money inflow into the economy and decreasing aggregate demand.
Yeah, an example of that was in 2008 in America. We saw that.
Yes, so the subprime mortgage lending crisis. So what have we got? Negative equity, mortgage defaults, and
The effect of that on bank balance sheets and financial
bank
stability,
balance sheet. Sure.
as well as the overall level of economic growth.
Sure. So if we were to see a harmful bust to the economy, to the housing market, or a sharp correction in those house prices, we would have a number of negative effects. Firstly, we'd see termed negative equity, which is when mortgages exceed the value of the actual house, so people owe more on their house than the house is actually worth, which for one makes people feel a lot poorer. It decreases the wealth effect and decreases the amount that those people, the majority of New Zealanders as homeowners or people that live in homes, are going to be spending. So that decreases their input into the economy, reducing aggregate demand. You're also more likely to get mortgage defaults under this collapse, which is negative for bank balance sheets, which is negative for the amount banks are going to be willing to give out in credit and give out on loans and that sort of thing, again decreasing those inflows into the economy and decreasing the amount of aggregate demand. And this is very similar to what set off the global financial crisis in 2008 with the subprime lending crisis in America in 2008.
Okay. So I'll change tack a wee bit. So in your discussion, you mentioned two things I found interesting when you put them together. You mentioned that fixed and floating mortgage rates are quite at historic lows, but you also mentioned that because our interest rates are high relative to other countries, that's causing the high exchange rate. So one's boosting aggregate demand, one's lowering aggregate demand. My question for you is, do you think monetary policy currently is on putting those two together, boosting demand or contracting demand?
So looking at the high interest rates pushing up the dollar on one hand,
Yes, so that
and
would
then
be
on the other,
other hand. So low mortgage rates, which are going to be increasing that inflation, and what was the other one?
The high interest rate
High interest rates. Compare it. So that results in more inflows into the economy.
So we're basically weighing up whether we think the dampening effects of a high exchange rate are going to be greater than the expansionary effects of low borrowing rates for consumers.
Well, at this stage, at this stage it would look like the borrowing rates would be more, would matter more because of the sheer amount of people in New Zealand who are homeowners. We do have a culture of home ownership rather than rent and that sort of thing like you get in other countries, so that matters quite a lot more to New Zealanders. Also, there's what about the investment? Why is New Zealand, is it that good of an investment decision for overseas buyers, for overseas investors? Like, are they putting that much pressure on the exchange rate when at the moment those other countries overseas, like we've seen Europe just coming out of recession, the US is back on its feet as they're appreciating the New Zealand dollars naturally currently, those factors are being offset by other markets picking up overseas. So maybe that would offset the amount that the New Zealand dollar is appreciating, offsetting that dampening effect. So the mortgage rates are probably more likely.
And looking at export conditions at the moment, exporters can deal with the high exchange rate in aggregate because they're facing increasing commodity prices and other positive effects on them. So I'd say that the low borrowing rates are increasing consumers' propensity to spend. We've seen massive household debt levels at the moment, as well as the effect on the housing market, which has been increasing inflation through the wealth effect.
And increasing construction costs through that as well.
Yeah.
As demand outstrips supply. Would you like to sum that up, Sam?
Yeah, so in aggregate we think that it would be expansionary. We think that the high interest rates that we have, although they are pushing up the exchange rate, we think that the factors which are pushing up the exchange rate, like interest rates overseas, are now starting to looking to increase and put less upward pressure on our currency. We also think that the current export conditions, that exporters can deal with a high exchange rate, and they're facing higher commodity prices. But when we look at low borrowing rates, that creates a huge amount of inflationary pressure because of the homeowner culture that we have in New Zealand. Through the wealth effect, people are feeling wealthier because of the house price inflation that those low rates set off, as well as the huge household debt levels that are being created and the spending incentives which those low rates are creating.
Okay, good. Thanks. Thank you. Through your answers and some of your presentation, you've talked about the high exchange rate and what that might mean. You've also talked about problems in the housing market. It's an interesting tension between the two. How do you think the macroprudential tools may change this situation?
Sure. So,
You go for it, Sam.
looking at the macroprudential tools, in terms of their objective, it's important to consider that they are separate from monetary policy. They are macroprudential policy, and they're not directly aimed at house prices. What they're aimed at is financial stability and ensuring that the banking sector can be resilient if there is an external shock and a sharp correction in house prices. But at the same time, they're a bit of a tester, but we are hoping that they will take a small amount of heat out of the property market through taking away some of that demand.
For example, decreasing those low equity to loan value loans that they've announced very, very recently.
So that's basically taking a portion of demand out of the economy of those people who have low equity.
We could also consider an offsetting factor. That is, a lot of property investors, they don't really care about the low loan to
they have high equity
because they've got high equity
anyway.
And basically that still might encourage housing prices to increase, especially first home buyers. They might not have the amount of money available to buy their first homes, and that might just encourage them to rent, and that would drive up rent and further encourage property investors.
So that will be an offsetting factor, but we will hope that they will take a small amount of heat out of the property market. And what that means is that it almost buys the Reserve Bank some time so that they can put off increasing the OCR
to make sure that growth does actually continue, because it's quite tentative growth at the moment. So we want to keep continuing that growth whilst making sure that the mortgage rates themselves, that the house prices themselves aren't too much of a bubble.
And obviously increasing OCR is going to put upward pressure on the dollar, and so through the macroprudential tools, buying the Reserve Bank time to hold off and increasing the OCR, we're allowing the dollar to depreciate. We're giving it more time, basically.
It also strengthens the bank's balance sheets because their loans are more secure and they've got more equity behind those lones.
So, would you like to summarise?
Yes, Sam.
Okay, so the aim of the macroprudential tools is to restore financial stability to the banking sector, as well as we hope to take a small amount of heat out of the property market through taking that portion of demand out of those people with low equity. That will be partially offset by investors coming into the market. However, we do hope that they will buy the Reserve Bank some time by keeping that asset price inflation under control. So it buys the Reserve Bank some time. They can hold off hiking the OCR for a while, which means that it allows the New Zealand dollar to depreciate naturally. It gives it more time, as well as because increasing the OCR will increase that exchange rate. So.
Very good. We're done. Thank you very
Thanks
much.
very much.
Excellent.
Thank you.
That's quick.